Okay, I'm gonna get started. Okay, thanks everyone for joining. Welcome to the class. Hopefully you'll learn something today. Um, it's a pretty easy strategy, selling covered calls. It's something that I've done myself for many years, and it's a good way to get income from your existing portfolio. So we're talking about meta stock, and now that all the employment dates have been hit and termination dates have been hit, I think all of us should be able to trade freely come Monday. Before we jump in, though, however, I would like to um, have you guys read through this disclaimer very quickly. Take about a minute and read this through. Essentially, what I'm saying is I'm not giving you any financial or investment advice. This is purely for educational purposes only, because I'm not a registered financial advisor, so I'm really not allowed to give you any type of financial advice. But I'm hopefully able to teach you something, a tool that you can use to do some trading and hopefully get a stream of income. Okay, you guys need a little more time, or can we dive in?
I'm good.
Okay, great. Um, Here's the agenda for this session. I'm going to get into an intro about myself, talk about some definitions, terms that we'll be using, a little bit about the option markets, pricing, frequency, the Black-Scholes equation, which is the heart of how options are priced, preparing your brokerage account, goals and strategies, and the mechanics of the trade. And at the end, I'll offer some tips and then wrap up with Q&A. All right. So a little about myself. Um, my educational background, I have a BS in mechanical engineering from UCLA, and I have my master's in business from University of Hawaii. I'm from Hawaii, but I've lived in the Bay Area for 20 plus years, so this is pretty much my home now. My professional background, as you can see here, many years in the tech industry, in the payments compliance space. But before I came out to the Bay Area, I worked as a financial advisor, and that's where I got my Series 7 and Series 63 license. And that's where I first learned about options, because that's part of the examination that you take. You have to understand calls and puts and understand what types of trades that people do, and because it is a core part of the marketplace for professionals. And in over the years, my trading experience goes pretty deep, over 30 years trading stocks and options. And I'm currently a level 3 trader, and you probably won't know what that means, but I'll explain later. But I feel I am fairly qualified to teach people about the basics of option trading. So hopefully you guys will learn something today. All right. Okay, moving on. Some definitions that we'll be using throughout the day. The first one, of course, is an option, right? What's an option? An option is essentially a contract which conveys to its owner, the holder, the right, but not the obligation to buy or sell a specific quantity of a security, of an asset, right? At a specified strike price on or before a specified date, depending on the style of the option. I mean, that's a mouthful, right? But essentially understand that an option it's a contract. It's a contract to give someone the right to buy or sell stock. And that's kind of what we're talking about today. A call option is the right but not the obligation to buy an underlying stock at a specific price. And a put option is the right but not the obligation to sell the underlying stock. Okay. One option contract is equal to 100 shares. So if you are an option buyer and you buy a call, you have the right to buy 100 shares if the stock hits that strike price. So strike price, that's the price at which a call or a put can be exercised. Okay. So, and then the spot price is the value, the current value of the stock. So Meta, for example, is 323. That's the spot price. That's what it is today. Okay. When we say in the money option, that means the option that has a profit opportunity due to the difference between the strike price and the spot price. So if Meta's at 300 and you own a call with a $250 strike, that means you're $50 in the money, right? So that's an in the money option because you now can buy it at 250 and immediately sell it at 300. That's an in the money option. An out of the money option is the option that has no intrinsic value because the spot price is below the strike price. So if Meta's at 300, but you own a call with a $350 strike price, that option has no value because the stock is not at the strike. You can't exercise it, right? So there's no value for that option. The expiration date is a specific time and date that an option contract expires. And we'll get into a little bit about frequency and expirations. So just understand that there are expirations to these option contracts. Option chain. So an option chain is a listing of all available option contracts, both puts and calls, for a given underlying security. It shows all the puts, calls, strike prices, and pricing information for a single underlying asset within a given expiration period. Okay, so these are some of the terms that we'll be using. So this graphic here is a good visual on just calls and puts and what your rights and obligations are. So let's look at the top row, right? So if you're looking at calls, right, remember the call option is the right to buy. So if you're long a call, which means you've purchased the call, then you want the green arrow, you want the stock, you're hoping the stock goes up, right? Conversely, if you're short a call or if you sell a call, you have the obligation to sell the stock. So this course, we're going to focus on covered calls, right? So a call buyer is the guy on the upper left. He's long a call. He wants to buy a stock at a certain price. As the option seller, you're going to be the upper right box. You have the obligation to sell, but only if the stock hits the strike price that the call buyer is looking for, right? So this is the relationship, between calls and puts, long and short. And so a call buyer is essentially placing a wager, if you will, right? He is betting that a stock is going to hit a certain price at a future point in time. But the call seller is essentially taking the bet. He's saying, I'll sell you this option, but I don't think your option is going to hit. So I'll sell you this contract, but I'm going to collect the premium that you pay to own that right. So that's where the income comes in. Okay. We don't need to get into puts because I think that gets into some of the more advanced techniques, but just understand that puts is a right to sell. And if you're long a put, that means you have the right to sell the stock. But if you're short a put, that means you have an obligation to buy. So this part may get confusing, so I'm not going to get into that, but we're focusing on covered calls today. Any questions so far? Okay, let's move on. Option markets, pricing, and frequency. So when you trade stocks, right, you guys are probably familiar with stock exchanges. So you have the New York Stock Exchange, you have the NASDAQ. That's where stocks, are traded. Options also have exchanges. So the common ones are these, right? The biggest one being the Chicago Board of Options Exchange, is CBOE. And this is where there's a whole marketplace. And these are folks that, deal with the option contracts. They match buyers and sellers, and they ensure an efficient market for buyers and sellers of options. How are options priced? So the Black-Scholes model is one of the most important concepts in modern financial history. This is an equation essentially, which theoretical value of derivatives based on other investment instruments. So it's a model that takes into account the impact of time and other risk factors for security. And so this was developed in 1973 and regarded as one of the best ways for pricing an options contract. You're not going to be expected to memorize this, but I just want to understand how options are priced, because the pricing of options is different from how stocks are priced, right? And we can talk about that in the next slide and go into the equation. The frequency of contracts. So up until 2005, option contracts would expire the third Friday of every month. So that means you only had one opportunity per month to trade, well, not to trade, but to have an option expire. And expiration is a very critical date, because that's when the buyer of the option knows whether or not they're going to make money, right? If the stock hits the strike price. And the sellers are interested because if the option expires, then that means that option is worthless. And so whatever the buyer paid to own that option is pretty much, gone, right? The money's in your pocket as the seller. So after 2005, the CBOE introduced weekly contracts due to increased demand. So now you've got options expiring every single Friday. So you can do trades and get like a weekly stream of income, because these option contracts are expiring every week. And we'll see some examples, so you can kind of see how this plays out when you're trading. So this is the Black-Scholes equation, right? I mean, it looks pretty complicated, right? But and it's based on various factors, right? So the C is your call option price. It's based on the normal distribution of the underlying stock, the spot price of the stock, the strike price, the risk-free interest rate, time to maturity, and the volatility of the asset. You're not going to be expected to memorize this or anything, but just this will help you understand how the price of options are set. And there is a formula. But the upshot here really is that contract pricing, option contract pricing, is based on the probability of whether or not the price of a stock will reach the strike price at a given point in time. So what that means is, for option buyers and sellers, you either pay more or receive more if the probability is high, right? The probability of the stock reaching the strike. And inversely, you'll pay or receive less if the probability is lower. Okay. Any questions on this concept? Okay, you'll see that in action. So, you can wait to see it when I go through some examples, and then I think things would be a lot more clearer. But a lot of it is based on probabilities and what you think a stock will do. Do you think it'll go up, or do you think it'll go down? And you would buy or sell a call or put based on what you think is going to happen. Okay, so let's get into preparing your brokerage account. I'm guessing many of you are new to options, and so you might need to do something with your broker in order to get ready for trading. So the first step is getting authorized. Make sure you have, you complete any forms or authorization that you need from your broker. So the example that I put here is from Schwab, because I trade through Schwab. They have different levels of authority to trade, because the broker doesn't want people to lose money trading options and getting creamed in the market by doing something that they don't understand. And so they have different levels of authority. As you can see, level 0 covers these strategies, including covered calls, which I've highlighted. Covered calls, covered puts, buy rights, unwinds, covered rollouts. I'm not going to explain these other ones, but I'm going to focus on covered calls because that's the most basic strategy. The other strategies, level 1, level 2, level 3, are all various combinations of calls and puts. So they've had different names for them too, like straddles, strangles, spreads, diagonal call, diagonal put, uncovered call, uncovered puts. And so it gets really, really fancy, right? As you dive deep into the strategy and determine what's the best, technique or strategy to put when you're trading. So as I mentioned before, I'm a level 3 trader. So I've done pretty much most of these different strategies over my lifetime. Next up, understand your trading platform. So be familiar with your trading platform and what the buttons do, right? Practice trading. I don't know if you guys use, Schwab or another broker, but I think a lot of people use Robinhood, and Robinhood has like a lot of does have options, on there, and I think it's pretty easy to trade. But a lot of brokerages have apps or widgets where you can do trading like a lot easier than going onto a website and inputting a trade. So make sure you understand the platform and practice before you do anything. Thirdly, determine which security for which you want to trade options. And so this class was really about Meta, right? Because I know we all own Meta stock. But I'm teaching you a technique to get additional income from your existing holdings, right? You're not doing anything different. You're not buying or selling your own stock, but you're trading the option that will give you additional income stream. Okay. So we're getting now into goals and strategies, right? The first step is determining what your goal is, right? Do you want to speculate? Right? Do you want to speculate? If you're speculating, then you're an option buyer. Whereas if you're an option seller, your goal is to get income. And so this chart is kind of nice because it kind of shows you what your expectation of the stock is, and that determines which option you trade and whether or not you buy or sell. So let's look at the calls. So if you're buying options, right, on the far left, you expect the underlying price to rise. And so you buy the option, right? Buy a call option. But if you expect the price to fall, you'd buy a put option, right? That's super basic, right? So focusing on calls again, right? So now looking at the far right box, right? The person that buys the call, he's expecting the stock to rise, but there has to be someone on the other side of that trade. So there's a buyer of the call, but there has to be a seller of the call. So the strategy that I'm teaching you is this sell call option, right? Where you're expecting the price to fall, right? Not necessarily fall, but you don't want the stock price to go higher and pierce the strike price, because then you now have the obligation to sell your stock. So the call seller is essentially saying, I don't think the stock is going to go up that much, right, by this certain date. And you're basically betting against the option buyer who's speculating because he thinks that the stock is going to go higher and go to a certain strike price. So this graphic kind of shows you at least what your expectation should be of the stock before you enter the trade. Any questions on this? Okay. This chart here talks about some of the common option strategies that people do. And this comes from the Schwab website. So the first line is essentially your covered call strategy, which is the objective is income generation. Your outlook is neutral to bullish, right? And you're basically selling a call against an existing stock position. And the trading level is zero. And that's an easy authority for your broker, because it's a fairly low risk type of trade because you already own the stock. The other option strategies for income generation is what they call a short put. You can sell a put, and that's secured by cash that you have in your account, but that has a trading authority of 1. And we're not going to talk about that today, but that is another income generating strategy. The other strategies, if you see here, are hedging, right? Or the objective is hedging and speculation, and those involve protected puts, where you buy a put, you do a straddle, where you buy and sell a call at the same strike, or if you do like a debit spread, where you buy and sell a call at the same time, or buy and sell a put at the same time. But these will require additional trading, additional trading authority to enter these trades, and so this will be more of like an advanced, trading course. But today we're focusing on income generation via covered calls. Okay. A little bit about option contracts and some statistics. So per the CBOE statistics, 10% of option contracts are exercised. So what does that mean? That means 10% of the options that are traded out there, the buyer of the option or seller of the option is able to exercise at the strike price because the stock was able to hit the strike price. And what that means, like for our Meta example, like if someone bought Meta at 350 strike and the stock was able to move to that 350 price, then that option buyer can exercise and now buy it at 350, right? So that's called option exercising. 55 and 60% of options are closed out prior to expiration. So that means someone bought or sold, but then they closed out the position. They didn't wait till expiration, but they unwound their trade by either buying or selling to unwind the contract. And then only 30 to 35% of contracts expire worthless. So I want to focus on the last piece here, expiring worthless. As an option seller, your goal is to sell options that have a high chance of expiring, because that's where you guarantee your profit. So the myth here is that 90% of contracts expire worthless, but that's because people only see that 10% are exercised. So they assume that the other 90% expire, but that's not true, right? However, the point here I want to make is option expiration is what you're aiming for. Like you want to find the contract that has a value of 0 on that Friday expiration, because that means the option buyer lost their money, but as the option seller, you've kept the entire premium that they paid, which is your income. So to sum it up, buyers of options are speculators, right? Sellers of options are seeking income. Option buyers are looking to pay minimum premium for maximum gain, so that they're more risk tolerant, and therefore they'll buy options that have little chance of being exercised. The goal of an option seller is to sell the contract that has the highest chance of expiring worthless, therefore keeping the premium collected from the option buyer as a profit. And the strategy of selling covered calls is the easiest strategy to learn and execute and has the lowest risk, primarily because number one, you already own the stock. Number two, if your stock gets called away, it would be at a higher price than what you paid generally. And the third point is that you can always adjust your position based on the market activity. So, for example, if the stock starts to move too quickly and it's moving toward your strike price, you could roll out that option by buying it back and then reselling another option at a higher price and at a later point in time. And I'll get into those examples a little bit later. But this pretty much covers your the strategy of selling a call. Any questions before we get into the mechanics? Okay, if none, let's jump into the mechanics of the trade. Step one, view the option chain for the stock. So what I've shown here is an option chain for Apple. And so when you're trading options for the first time, you're going to see, in your brokerage account, a link for options. So you can finally click on that because you might wonder what that was. You click on options and you look for you type in your underlying symbol, the stock price, the stock ticker, and your option chain will appear, and it'll look something like this, right? It'll have your calls, your puts. The blue shade is in the money, right? Because the strike price is below the spot price, right? So you see 175 to 192.50. These are in blue because it's under the strike. I'm sorry, it's under the spot. And you'll see these different metrics. You'll see the volume, how many contracts are traded that day. OI is called open interest. That means these are the contracts that have been traded by various people, right? It could be, hedge funds, money managers, right? Individuals. And these are contracts that have traded but have not yet been closed out. So it's an open interest. There's an open buy or an open sell. The last here is the last trade, the change for the day, change in price for the day, and then the bid and the ask. The bid is what you would what you would sell at, and the ask is what you would buy at. So, for example, the 195 strike. If you're a buyer of the option, you would pay $3.75 a share for that option. And if you're selling this option, you're receiving $3.70 a share. Okay. So in this particular chain, let's look at what an option seller would look at to sell. Because what is the goal? Remember, what did I mention before? The goal is to find the option contract that has the highest probability of expiring. Okay. So when you look at this chain, as you go down the chain to see the higher strike prices that are out of the money. Oh, one thing I forgot. The time period that I selected was August 4th, 2023. That's next Friday. Okay. This says 10 days because I pulled this chart on the 25th. But essentially between now and next Friday, there's only 5 more trading days. So including today, actually. So 6 trading days because today's not over yet. But there's only 5 days left. But per this chart, there were 10 days left. But if you look at what the probability of Apple, the price of Apple, what it could go to, if you look down here, like 205, 207.50, 210, right? Which one do you think has the highest or a higher probability of expiring? And basically the question you're asking yourself, can Apple move up? Let's say I pick the 210, right? Can Apple move $15 in 10 days? So that's the question you're asking yourself, right? And if you're a conservative, you would pick the higher strike because the higher it goes, the chance of it happening is going to get smaller and smaller. And therefore, your option price gets smaller and smaller. You see here, 23 cents on the bid, 24 cents on the ask. So the call buyer is saying, man, I think Apple's going to go higher, right? Even with no news, right? Apple already reported earnings, so there's nothing that's going to really spike it. But some call buyer is going to think, yeah, I think it's going to move up big because the market's moving big. So I'm going to buy this option, and I'll pay 24 cents a share to own this right. Okay, so let's say the person did that. So step one, you got the option chain. You determine now 210 is what I want to sell because I feel like this option buyer really doesn't know what he's doing, and I'll sell you this contract. I'll sell you this 210 option that expires in 10 days, and I'll collect your premium. Okay, so you determine the expiration date, which is this one, August 4th, the strike price, and the option you want to sell. So we're doing calls, 210 strike, expiring August 4th. So you execute, you put in your trade, and here's what your trade window should look like, right? You place your order. Strategy is covered call or short call. The action is sell to open. So you notice here, sell to open is what you're going to open your trade with. So you're selling to open the trade. The other options are buy to open, sell to close, and buy to close. Okay. And essentially, when you're selling a call or selling a put, you sell to open the trade. But when you close a trade, you're buying to close. Okay. And the quantity I put in is one contract, so that's 100 shares. So in 10 contracts is 1,000 shares, right? And that's the quantity here. Expiration is August 4th. Strike price is 210. And then I put a limit order, kind of like how you do for stocks. You put in the specific price that you want. And so I put in a limit order of 24 cents. Okay. So what happens? So the amount going into your account is going to be $24 for this one contract. So $24 is based on 100 shares times 24 cents, which is the premium, right? Less commissions. So it won't be 24, it'll be a little less because you have to pay commissions. So obviously, if the more shares you have and the more contracts you can sell, then the more premiums you collect. So if you had 1,000 shares and trading 10 contracts, you'd have $240 in your account. At the moment you place that trade, that money shows up in your account. Isn't that great? And that's where your income comes in. Okay. Any questions on the mechanics? Is it pretty clear so far? Are you guys following along? Good. Thanks, Shane.
Don't mention.
Okay. So once the trade is in, now you monitor the trade, right? Because you want to make sure that your call option, your short call option is safe. So if all goes well, you do nothing and you watch the stock, you watch Apple close below 210 before August 4th. And come that Friday, it could be 205, 208, 209. Doesn't matter, right? It needs to hit 210. If it doesn't hit 210, that option's expired. And that $248 is safe. in your account, right? If the stock starts to spike and move close to 210, then you need to potentially make some decisions, right? You can just sit tight and watch it, right? If it goes to 208, 209, you might get nervous, but you could wait until the expiration date and decide what you want to do. You can close out the position by buying to close, right? Like reverse your trade and just close out. You might lose money on this one, but that's better than selling the stock, maybe, right? Uh, the third option, roll out the position to a future date by um, buying to close your short call and then simultaneously sell to open a new order at a higher strike at a later point in time, right? And then lastly, you can let the stock get called away, which means you sell the stock at 210, right? And some people might want to do that. They might use a covered call as a strategy to sell the stock that they were going to sell anyway. So you might as well get some money if you're going to sell the stock at a certain point, right? At a certain price. And that's another strategy, right? But essentially, if you're not greedy and you choose the option that has the lowest probability of being exercised, you will win the trade most of the time. And that's what I experience when I trade. And and I'm fairly conservative with my trading. So some tips: be mindful of earnings, right? Do not trade when there's an earnings release and the release is the same week as your expiration date, because as you know, right, earnings are released after market, and then the stock could go crazy and you could get caught on the wrong side. Start off with small and fewer contracts, and also do some paper trades and monitor to see how you would have done. A conservative trader can realistically achieve 1% extra return on their stock per month. So realistically, it's like 10 to 12%, right? And you could, if you're trading weekly, your goal is to get 0.25% every week if you're trading weekly options. Remember now, you're getting income, right? So any proceeds from your covered call trading that expire within a year are considered short-term capital gains and will be taxed based on your own individual tax rates. And so when you do your taxes, make sure you're reporting it correctly. And then lastly, enjoy your extra stream of income and happy trading. Okay. This covers the formal part of the presentation. We can probably open up for Q&A, and since we have time, I can go into a live chart of Meta so that you can see what some potential strategies are, and you can look at something real time and something that I can do an analysis for you to see what I think are good opportunities. So I'm gonna stop sharing this window and share this window. Okay, can you guys see this one? Okay, good. Before we analyze Meta, any questions? Any general questions? Did I confuse any of you? Have you guys all followed along? Make sense? You guys ready to make some money? Vivian, thank you. What's your question?
Hi, thank you for presenting this today. I was wondering if you'll be sharing the slide deck later.
I can do that. Yeah, I can
Awesome.
post it. Um, I could probably just email it to those that are interested, or send you a link to. Let's see. Yeah, I can notify you. I mean, I can email you, or just ping me if you want it, then I can shoot it over to you. Any other questions? Okay, let's look at Meta. I pulled this up on Yahoo and I clicked on the options tab here and I looked up the August 4th expiration, which is next Friday. Okay. So they show calls first and then they show puts on the bottom, but we'll focus on the calls. So the area in blue is in the money, right? That means all the strikes are below the spot price. The ones that are out of the money are in white. Okay. Um, okay, now as an option seller, you're looking at all the ones that are here that are out of the money that have potentially low probability of hitting, right? And the thing I do want to caution for Meta, however, though, is that it's been on a really, really huge run, right? And the stock does have a bullish trend at the moment. And so remember, when you sell calls, the sentiment really is neutral to bullish, but um, because you don't want the stock to go that high. It's okay to go high, but not that high. That's kind of the message, right? Um, if it goes down, that's even better because there's no way the stock is going to hit the strike. But if you look at some of these strikes, would you sell an option here at 325 for next Friday? How many of you would do that? Not many, right? Because the premium is 570 bid, 575 ask. But the stock only has to go up another $2. Actually, no, 50 cents before it hits that strike. So, the chance that it'll go to 325 by next Friday is very, very high. But as you can see, you're getting a lot of premium for it. You're getting $5.70 a share for selling this call. But the chance that you're going to get called away is very high. So you might end up selling it at 325. But effectively, you're selling it at 330, right? 330.70 because you add the premium that you collected to the strike price. And that's your proceeds. Okay. Does that make sense? Okay. So if you're looking at an option that has a lower chance of hitting, you're not looking in this range, right? You're looking at the 345, the 350s, the 355s, right? That's where I would look, right? And if you look at what was my conservative return? It's 1% per month, right? So if you're trying to get 0.25% in a week, which strike should I be looking at? Right? So it's at 324 divided by 12. Actually, not divided by, it's 324 divided by 10. Let's say 10%. I'm sorry, it's 1%. It's 324 times 1% and then divide by 4, right? So 81 cents on a weekly basis will get you that 1%. So which option is close to 81 cents? It's this one, right? It's the 345. So now the question is, in 5 days, can Meta go from 324 to 345? Right? That's the question you're asking yourself. Right? It's possible, right? It could go up $20 in 1 week. But remember now, Meta just reported earnings. And so the big move has already been made. And if it does start to move, it might go up like a couple bucks each day, right? Even today, well, today there was some spillover from earnings. It's up $12, $13 right now. But next week, absent any earnings news or any other news that would impact the stock, it should be trading, fairly flat, but maybe a little bit, higher. But could it go $20 higher? Right. So that's the question you're asking. If you're not comfortable, then go up another strike. Go to 350, right? And now you're getting 43 cents a share. So assuming I'm gonna assume that a lot of you have at least 1,000 shares, right? Maybe you've accumulated that over the lifetime of your employment. But now at 1,000 shares, 43 cents a share, you just made $430 for the week. And that's nothing to sneeze at. And that shows up in your account right away. And then you do this every week. And you've now got, some pocket money every month. Right. And so that's kind of the strategy I'm looking at. One other tip that I have is try not to trade options that are too far out of the money. Like I looked at August 4th, right? But you can look at all these different expiration dates: August 4th, 11th, 18th, 25th, and then it starts to skip. It starts to skip weeks. September 1, 15, October 20. Then it goes into the months now, right? You could even trade something as far as December 19th, 2025. Right? So you can really make some crazy bets with your options. But the further out you go, then you really run the risk of unusual events, something that could happen. I mean, there's so many things that could happen that could impact the stock price that you just don't even have any control over that. And so I like to do the ones that are like 1 week out or 2 weeks out. Then you have a shorter time period for that stock to move, and you can make adjustments, on the fly and roll up to a different week, right? If the stock is moving against you. But try not to leave too much time value for the option, because you don't know what could happen. Okay. Any questions on this live example? You guys are ready to go, ready to make money? Yes. Thanks, Shane. Anyone else?
I have a question.
Yeah.
Thank you, Christopher. It's very useful. If it hits the strike price, is it guaranteed that my stock is going to be called away?
If it closes on the expiration date and the share price is at or higher, then yes, it will execute. It will execute automatically in your account. You don't even need to do anything. You're obligated to sell it at that strike price.
Got it. What happens if it's hit the strike price before?
If it hits the strike price before, but it hasn't expired yet, then that option is still live. It doesn't necessarily get exercised the moment it hits the strike.
But it still can? Like 2 days before the expiry.
It depends. Sometimes stocks will get called away before expiration, but it depends on who the option the call owner is, right, and what they're doing. That happens rarely. Sometimes people will exercise before the expiration if the strike has already been hit. But most times, if a stock pierces the strike price before expiration, nothing happens. You have to wait until expiration before either it gets called away or the contract expires.
Got it. Thank you.
Yeah. But and that's why monitoring the trade is important, because once you put in that trade, you want to keep an eye on it, right? I mean, you don't have to watch it like, nonstop the whole day, but keep an eye on on the stock price, and just kind of like see how it's moving, over the course of the week. And if you see it start to creep up toward your strike price, then you need to maybe make some decisions. But ideally, if you do it conservatively, you don't need to do anything. You just watch it, and it will close underneath, below the strike, and then you rest easy, on Friday when it expires.
And you can only do this if you have enough stocks in your account, right?
That's correct. You need at least 100 shares of any
Got it.
security to trade one contract,
Got it.
right?
Thank you.
So obviously, the more shares you have, the more contracts you can sell, and then the more premium you can collect. Right? That's a good question. And the thing is too, I mean, some of you might think, like that Apple example, right? 100 shares of Apple, I got $24. I mean, is getting $24 worth my time and energy, right? But I always come back and say, well, if you're on the street and you found a $20 bill, do you stop and pick it up? Right? Anyone would, right? Assuming that it's truly lost, and you're not stealing anyone's money. But if you found money, you would pick it up, right? The way I see option trading, it's like found money, because you're essentially betting against a speculator who thinks the stock is going to go crazy and maybe hit a strike price that he has no chance of hitting, right? So going back to this Meta example, if you said, okay, 360 by next week, I mean, what is really the chance of that happening when earnings have already been out, right? The big move has been made. The stock has to move another $35 in 1 week to hit that 360, right? Would you grab this 13-cent premium? Let's say you got 1,000 shares, right? $130. Would you look at that and say that's almost free money, right?
Yeah.
Okay, so trading now is a function of what's your risk tolerance and what you're willing to risk, right? At the end of the day, you're risking your shares, and if you do sell it, you're selling at 360, which is higher than what it is now. But I think for most of you probably want to hold on, right? So you want to sell the contract that has the lowest probability of being exercised and the highest probability of expiring. For me personally, I've traded, I've sold options where it's a nickel and even a penny sometimes, right? But that's because I have a lot of shares. And if you have a lot of shares of a lower price stock, you can trade more contracts and you can grab those nickel premiums and still make a pretty good income from that trade. And so the way I see it, you're really skimming from the market and giving yourself an extra income stream from your portfolio, because you can apply this to every stock that you own, right? It doesn't have to be Meta. It can be any stock. And you could do this across the board. And every week, 100 shares, 500 shares, whatever it is, trade the number of contracts, and then look at what income you can generate from that portfolio. So it's a strategy that, I've been doing for 30 years. It's worked for me. But I can understand if you're new to this type of trading, definitely start off small and do more research, understand how the trade looks in your account, right? Go through the mechanics, go through what it looks like in your portfolio, and look at how the option price changes as the stock price changes. And then that way you get more and more familiar with the mechanics and the trading, and then you can then step into more and more exotic, strategies over time. Okay.
Chris, I had a quick question.
Yep.
With your Schwab, how do you get them to up level you from, beginner's level to the next level of trading? Do you just
you have to apply. There's actually an application.
Okay.
Yeah, there's a form, and then you have to indicate years of experience, what your average trade size would be.
Okay.
And what Schwab does is they look at your account because they have all the info there, right? So they can see what types of trades you've done and how well you've done, and you can get approvals, through that application.
Thank you.
Yeah.
Christopher, can you show us, if you have time, can you show us how to do that kind of rollover? If it's getting close to the strike price, we still want to keep the price, like the stock.
Oh, the rollout? Sure.
Yeah,
Sure.
rollout.
Yeah. Okay, so a rollout is essentially 2 trades now, right? And so let's say for example, you did this meta trade at for August. Let's say you did the 330 strike, and you're not comfortable anymore. You're thinking, yeah, it'll probably hit. And actually, no, let's do this. Let's do the 325. So let's do the 325, and you're starting to sweat because you're like, okay, I don't think, I'm pretty sure it's going to hit, and I've already, sold the option. So to roll out, what you're going to have to do is you're going to have to buy it back, right? You're going to have to buy the stock or buy the option back at the current price, which would be your 545. You're now buying, right, to close. So you're paying 545 a share to close this particular contract. But then at the same time, what you're going to do is you're going to go to a future point in time. So let's call it August 18th. And now you're going to sell another option that has a similar or higher premium. So you can now sell the 335s, right? You went $10 higher, and you've collected 585, right?
So
remember,
this is basically you do like a 2 trade.
That's exactly right. That's 2 trades, because you bought the first one back at 545, right? And then you're selling a new one at 585. So you actually netted 40 cents.
Yeah.
You got a 40-cent credit by doing this rollout.
Yeah.
But now your strike is 335 instead, but 2 weeks later.
So you can continue doing this.
You can keep doing it. You can keep rolling out in perpetuity if you want. Right?
Cool.
But in a rising market, this strategy is dangerous because the stock is going to keep going higher and higher and higher, right?
Yeah.
You're basically waiting for a break when the stock is going to take a dip at some point, and then you can try to unwind your trade by rolling out to like a closer strike and try to get out, or buy back the option, wait for the stock to stop dropping and then resell it or something like that. I mean, there's different ways to do it, but it's really understanding the underlying security and the characteristics. So right now, a lot of tech being short is risky, right? Because everything's going higher. And so cover calls in a way you my recommendation is to be super conservative because the stocks could move higher than you think, right? So in a rising environment, in a bullish environment, the strategy to use really is to sell puts, but then that requires higher authority and it requires more cash because you may need to buy the stock if the stock gets put to you. And so remember, that was trading level 1 for short puts. But short puts is the ideal strategy for rising markets. Okay, but the goal for this class is really just understanding this one concept of covered calls, right? So just be more conservative in the beginning and just test it out, right? So, you know, going back to my my example for next week, if next week, if you guys want to just do a test trade, grab the nickel. Okay, I mean, I would recommend you guys sell the 370 call expiring next Friday, get a nickel. However many shares you've got, multiply by nickel. That's what's going to show up in your account. And come next Friday, when it's at 330 on Friday or 340, doesn't matter, right? The contract's going to expire worthless.
Chris, how
Okay.
do you think about longer contracts? I know right now you're showing us like a week out expiration.
Yep.
But do you have any strategies for like a month out or even like a long hold?
To sell or to buy?
For the covered calls?
Or for cover calls? The strategy is going to be similar because it's about expectations again, right? You just want to, you know, make sure that you're comfortable with the potential risk, right? Because if let's say September, okay, you go September and you look at the potential strikes, right? It's really what you think the stock is going to do. And so you might want to do your own research and look, you know, read
Right.
analyst reports, what they think, you know, look at what, you know, how brokers will give a price target, right?
Yep.
A lot of times price target is based on what it will do in the next year, right? And so you could look at available research and help you determine or forecast what you think the stock could do, right? So for this example, if it's September, I put September 15th, right? By September 15th, which is like maybe a month and a half away, you know, your premiums are going to be higher, right? Because you've got time premium now in addition to the intrinsic value. So at 380 in a month and a half, could it go to 380? Maybe, right? Maybe not. It really depends on what your expectation is. But it's hard to forecast as the time period increases. That's why I don't recommend, you know, long periods, unless you have a really, really long time horizon and you feel like at some point I'm going to sell my stock, right? You could do what they call leaps, right? Leaps are like these guys.
Yep.
Okay.
Year.
Yeah. September 2024, December 2025, right? If let's say that you think it's going to go into the 400 at some point, which is, you know, likely, right? But look at the premiums you're getting, and look at there's people trading it too. You've got open interest and volume even at these levels. So you've got, look at this one. There's 92,000 contracts open interest of the $600 strike.
Those are people interested in buying contracts?
No. These are people that have contracts that are outstanding.
Outstanding, right.
That they haven't closed out yet. But look at this. You can get $26 a share.
Right, that's great.
Right? So Leaps is a really good way for like the long-term holders, right? You're getting an extra $26 a share, but you're waiting 2.5 years. But if you did ever sell, you're selling at $600 a share.
Right. So you're kind of just choosing what you yourself are comfortable with, right? If you're ready to get rid of some stock, even short term or long term
That's
at
right.
that price. Okay.
That's right. That's right. I mean, when you look at this many contracts, I
That's
mean,
wild.
that's crazy, right? I mean, there's a lot of people who are trading this. And I think a lot of these guys are like hedge funds and money managers, right? You look at the puts. There's really nothing. People aren't even trading puts for these leaps.
Yeah. Well, thank you for that.
Yeah.
If you are selling for that like a long-term contract, Schwab gonna know that you are selling like 2,000 share in 2 years. You are not going to be able to do like short term if we assuming you only have 2,000 shares in your account.
I'm sorry, what is the question?
Like there's some people is like is trying to buy the contract you know, in a year, right? Like it's gonna expire in a year. You're gonna sell it to them. You're gonna sell like a 2,000 share. It's gonna expire in a year, but it means that you're gonna you have to hold these
You have to
2,000 share
hold it.
in
Correct.
your account. That is
correct.
yeah.
Correct. By
Schwab
definition,
gonna not allow you to do anything with this share, or
That-
you have to
that's-
just to remember it.
well, you technically shouldn't do anything with the shares, right? Because your covered call is covered, or your call contract is covered by your shares. If you sell the shares, then it becomes an uncovered call.
Yeah.
And you would need to have cash in your account to cover that. Right?
Mhm.
So if you do a long-term short call or cover call, you can't touch your shares. You really shouldn't sell it or do anything to it until that contract is either been closed out or expires.
Is your brokerage smart enough to actually know that when you sell the room?
Oh, sure.
Yeah.
Oh, sure. What if you have a covered call and you sell your shares, your margin requirement immediately goes up because you now don't have the shares anymore to cover that option. Because if someone were to exercise and buy it, you don't have the shares available to sell.
Yeah.
So then the broker is going to require you to have money in your account to buy those shares at that strike price, because you have to buy it and then sell it at the same time.
Got it.
Good questions, guys. I mean, yeah, I think this is like the fun part, right? I taught you the basics, but there's so many different strategies involved, and as you get deeper into trading, you know, you'll learn some of these things and kind of learn the characteristics of how the option prices start to change based on how the stock price moves. Alrighty, we're almost a quarter after 12. Unless there's no more questions, we can probably wrap it up. You know, feel free to ping me online with any questions. If you guys need help with anything, I'm happy to help you guys.
Chris, thank you for this. This is awesome. One last quick question. What are some of your other favorite stocks that you do covered calls on?
Good one. I do Palantir regularly, Apple, Google, a lot of the big techs. One of my favorite ones recently has been a company called SoFi, S-O-F-I. The reason why I like it is because it has a low share price and a high market cap. So it's like an $8-9 billion company right now. But their stock is only like a $9 and change. And so you could actually, acquire more shares and sell more contracts, and it's a lot more fun when you can, ladder into a position and not just do a 10, 20, but you could do like 50, 100 contracts and kind of like scale into a trade and not do everything all at once. You could sell some one day, sell some another day, and you can do more elaborate strategies with more contracts. And so some of the lower price ones are the ones that with high market cap are the ones I like.
Thank you for that. That's awesome.
Mhm.
This one's a funny one, but what are your thoughts on Tesla, the volatility on Tesla?
I've traded Tesla before. It is very volatile. Yeah, super volatile. I mean, I've gotten to the point where even if I'm conservative, Tesla could just have a wild swing, like on any given day. I mean, news or no news, something could be out there that's even unrelated to Tesla that could impact the share price. And so Tesla, I would tread lightly on that one because you could get burned really fast.
Thank you. Thank
Yeah.
you.
Well, I'm excited to hear, if you guys actually start doing this and what your experience is. But I definitely enjoyed, teaching you guys and helping you guys learn this strategy. Hopefully you can incorporate it into your day-to-day trading and get an extra income stream from your existing holdings. So yeah, thanks for joining.
Thank you.
Chris.
Thank you so
Okay.
much.
Thank you so much, Chris.
Okay. Thanks, guys. Take care.